Why smart investors are selling stocks before 2025 market crash ahead. As 2024 draws to a close, a noticeable shift occurs across global markets. Seasoned investors are increasingly choosing to reduce their exposure to equities, reallocating capital into safer havens like bonds, commodities, and cash. This quiet exodus from stocks isn't random. It's rooted in caution, informed by patterns, historical cycles, and a growing sense of unease about what 2025 may bring. Why are so many smart investors pulling out now? Is a market crash on the horizon? Let's take a closer look at the warning signs, the economic indicators flashing red, and the strategies professionals are adopting in response. The warning signs of a tipping market. For over a decade, financial markets have been on a bullish run, largely fueled by low interest rates, cheap money, and aggressive monetary policies. But the tide began turning in 2022 when inflation spiraled out of control and central banks worldwide launched an aggressive tightening cycle. Although inflation has since moderated, it hasn't disappeared. Meanwhile, interest rates remain historically high, squeezing corporate profits and consumer spending alike. Moreover, geopolitical tensions, ranging from the Russia-Ukraine war to instability in the Middle East and the economic decoupling between the US and China, are adding layers of uncertainty. The global supply chain has still not fully recovered, and disruptions in energy and food production are continuing to impact prices globally. Layer on top of that the potential for a major economic downturn, and you have a cocktail of catalysts that could very well lead to a significant correction, or worse, a full-blown crash. Earnings are slowing, but valuations remain high. One of the core concerns among institutional investors is the current mismatch between stock valuations and actual corporate performance. Despite signs of slowing earnings growth, the S&P 500 and other major indices remain near all-time highs. In many cases, this can be attributed to a handful of tech giants propping up the index. The price-to-earnings (PE) ratio of many stocks remains inflated even as economic conditions deteriorate. Companies are facing rising input costs, higher debt servicing expenses due to increased interest rates, and weakening demand across several sectors. That's a dangerous mix. When prices are high and profits are under pressure, it creates a precarious environment where any negative catalyst could trigger a sell-off. Savvy investors are asking, why risk riding a wave that's already breaking? Historical market cycles point to a downturn. Markets are cyclical. History has shown us time and again that bull markets are inevitably followed by bear markets. The average length of a bull market is about 5 to 7 years, while bear markets tend to last 1 to 2 years. We're now well past the average bull market duration, even accounting for the brief COVID dip in 2020. What's even more telling is that we've seen this pattern before. Before the 2008 financial crisis, many investors dismissed early warning signs: over-leveraged banks, a housing bubble, and irrational exuberance. Those who exited early preserved capital and had the opportunity to re-enter at bargain prices. Smart investors aren't making the same mistake twice. Many are now acting preemptively, lightening their portfolios in anticipation of a similar downturn. Rising debt and government spending. Another major factor contributing to investor anxiety is the unsustainable level of government debt, particularly in the United States. As of late 2024, U.S. national debt has surpassed $35 trillion, and interest payments alone are approaching $1 trillion annually. This is simply not sustainable. With the U.S. entering a presidential election year in 2024, political gridlock has stifled meaningful fiscal reform. Massive government spending packages, combined with high interest rates, have only worsened the debt burden. Eventually, this will demand higher taxes, spending cuts, or both, none of which are particularly good for stock markets. If the US economy slips into a recession in 2025, debt pressures will grow more severe, potentially triggering a crisis of confidence in US financial leadership. Inverted yield curve and recession indicators. One of the most consistent recession indicators, an inverted yield curve, has been flashing warning signs throughout 2023 and into 2024. An inverted curve, where short-term interest rates are higher than long-term rates, often precedes an economic downturn. It suggests that investors expect weak future growth and are seeking safety in long-term bonds. This classic red flag has been ignored by some retail investors, but taken very seriously by institutional players. It's no coincidence that smart money is flowing out of equities and into longer-duration treasuries, gold, and even defensive sectors like healthcare and utilities. Tech stocks, too much risk for too little return. A major part of the 2023-2024 rally has been driven by artificial intelligence and tech hype. Companies like Nvidia, Microsoft, and Meta have seen massive gains. While there's no doubt that AI will shape the future, there's a valid argument that expectations and stock prices have gotten way ahead of actual performance and profits. What happened with the dot-com bubble in 2000 is eerily similar. Massive speculation, sky-high valuations, and an eventual crash that wiped out trillions in market value. Smart investors today are wary of history repeating itself and are trimming exposure to high-growth tech in favor of more grounded investments. Flight to safety. Where is the money going? If investors are selling stocks, where is their money going? The answer varies depending on risk tolerance, but there are clear trends. Bonds. With interest rates remaining high, bonds have become attractive again after a decade of low returns. Precious metals, gold and silver, are seeing renewed interest as inflation hedges and safe haven assets. Cash. Holding cash is no longer a penalty, as savings accounts and money markets offer 4 to 5% interest. Defensive stocks, utilities, consumer staples, and healthcare are gaining attention as they tend to hold up better during recessions. By diversifying into these areas, smart investors are positioning themselves to weather any storm that 2025 might bring. Better safe than sorry. No one has a crystal ball. It's impossible to predict the exact moment a crash will occur or how severe it might be. But what is clear is that multiple red flags are appearing across the financial landscape. Whether it's unsustainable debt, geopolitical risks, high valuations, or slowing growth, the risks heading into 2025 are far from negligible. Smart investors aren't necessarily predicting doomsday. They're simply preparing for the possibility of a major correction. By selling now, they reduce exposure, lock in gains, and build liquidity to seize future opportunities when prices drop. As the old saying goes, you make money by buying low and selling high. Maybe the best time to sell is when others are still buying, before the music stops. Let me know in the comments section below. What do you think of our video? If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.